You've seen in the chapter on the GDP that changes in government expenditures can either increase or decrease economic growth. The government can influence the economy in other ways too. Congress can pass laws changing business and consumer taxes, and the Federal Reserve Bank can take actions to influence interest rates. Higher interest rates are contractionary and lower interest rates are expansionary. Decisions made by the Federal Reserve Bank, specifically the Open Market Committee, affect interest rates and are referred to as monetary policy. That's what I'll be talking about in this video. First, however, to understand how this works, you have to understand some things about the money supply system and the banking system. In the market for money, and we're talking about US dollars, there is demand and there is supply. You can think of the interest rate as the equilibrium price of money. The demand for money is affected by several factors, but for the sake of simplicity, let's assume that it is unchanged. If the supply of money can be increased or decreased, or graphically the supply curve shifts out or in, the equilibrium interest rate will fall or rise. Let's play around with that a little bit. In this graph, we see some monetary policy action that has increased the money supply. Okay, so we've shifted from S1 to S2. Okay, the vertical supply curve shifts out to the right. The demand curve is unchanged, so the equilibrium interest rate, shown on the y-axis, is going to drop. Here it was at curve S1, our equilibrium interest rate was around 6%. And now when the curve shifts out and it crosses the demand curve here, our equilibrium interest rate now is around 4%. And we use a vertical supply curve because we assume that the Fed controls the money supply and they are not going to change the supply just based on interest rates. When the Fed takes some monetary policy that decreases the money supply, okay, the supply curve shifts in to the left, resulting in higher interest rates, and an increase in the money supply, interest rates decrease. Decrease the money supply, interest rates increase. That's a super quick overview of money supply and how it changes interest rates. So here's what you need to know about the banking system. It helps to understand banking operations today. If you understand the basic business model of a savings and loan years ago. Long ago, before the Fed even existed, savings banks were allowed to receive savers' deposits and use all of that money then to lend out to borrowers. Why would they want to do that? Well, that's the business model of a bank. The bank pays a small rate of interest to depositors and charges a higher rate of interest to borrowers. The difference between the two rates is the profit for the bank. The bank counts on the borrower paying back the loan in time for the depositor to withdraw all of her funds. And when that happens, all's well. And with just one depositor and one borrower, it could be rather tricky though. But with thousands of depositors and borrowers, then they only ran into trouble whenever depositors wanted to withdraw their funds all on the same day, and they called this a run on the bank. When the Federal Reserve was created in 1913 in response to bank failures and bank runs, banks were no longer allowed to lend out 100% of deposits. Banks are now required to hold back some percentage in reserve. This is called the required reserve. How does the required reserve affect the money supply? Think about this. Assume that the required reserve is 20%. So for every $10,000 deposited, the bank must hold back $2,000 in reserve, and it can lend out $8,000 or 80%. So here's a little kind of a story. Assume here that John deposits $10,000 in the ABC Bank. The ABC Bank can then lend $8,000 to Laura, who deposits it in the DEF Bank. The DEF Bank then can lend out 80% of that, or $6,400 $400 to Paul, who deposits it in the XYZ bank, and then the XYZ bank can lend $5,120 to Sandy, who deposits it in her bank, and around it goes. Now, this could happen all on the same day. If so, then the money supply on that day, which includes all bank deposits as well as currency in circulation, time deposits, and savings accounts, has just increased by a total of $29,520. Let's look at the discount rate. Another aspect of bank operations involves maintaining just the right amount of cash on hand. From one day to the next, a bank may have either have excess cash or insufficient cash for daily operations. One function of the Fed is to act as the bank's bank. Every bank in the system has an account with the Fed where they can deposit excess cash or borrow needed cash. The Fed charges interest to banks who borrow from the Fed, and that rate is called the discount rate. If the discount rate is low, banks will be more inclined to borrow from the Fed and then lend money to their customers, their usual business model. If the discount rate is high, then it will be more difficult for banks to borrow or to profit by lending to customers. And so they'll be less inclined to borrow from the Fed. Let's look at the Fed's three tools. In just a minute here, let's take a look at this. Here's your bank's profit model. All right, so now we're going to look at the Fed's three tools one by one. The first two tools, the required reserve and the discount rate, affect the money supply indirectly through the banking system. The third tool, open market operations, affect the money supply directly through the Federal Reserve actions. So you've already seen how bank lending affects the money supply and how the amount of lending allowed depends on the required reserve. Now think about how the Fed can change the rules on the required reserve in order to either increase or decrease the money supply. If the Fed decides on a contractionary monetary policy of higher interest rates, then they would increase the required reserve. A higher required reserve means less money is available to banks to loan out, meaning the money supply decreases, shifting the money supply curve in to the left and raising interest rates. On the other hand, if the Fed decides on an expansionary monetary policy of lower interest rates, they will reduce the required reserve, meaning banks are allowed to loan out more of their customers' deposits, which will result in faster growth in the money supply, shifting the money supply curve out to the right and reducing interest rates. The discount rate. Banks can borrow and lend money among themselves, or they can borrow money and deposit money on account with the Federal Reserve Bank. In the case of borrowing money, if other banks either are not willing to lend to them or their rates are too high, banks will borrow from the Federal Reserve Bank. If the Fed decides on contractionary monetary policy, then they will increase the discount rate, discouraging banks from borrowing money from them. This decreases the money supply and increases interest rates. If the Fed decides on an expansionary policy, then the action is the opposite. The Fed will decrease the discount rate, encouraging banks to borrow from them, resulting in more money in the money supply and lower interest rates. Open market operations. First, to understand open market operations and how it affects the money supply, you must remember this. Any money held by the Federal Reserve Bank is not part of the money supply. Money in checking accounts, savings accounts, CDs, and currency make up the money supply, money that's available for transactions in the economy. Money on deposit at the Federal Reserve Bank, on the other hand, is not available for transactions in the greater economy. There's a very active financial market called the bond market. Corporate bonds, municipal bonds, mortgage-backed bonds, other securities, and U.S. Treasury bonds or treasuries are bought and sold every day, and millions of dollars change hands. The Federal Reserve Bank buys and sells treasuries and mortgage-backed bonds as part of what is called open market operations. They're not trying to make a profit from their trades, but instead are acting on their monetary policy decisions to either increase or decrease the money supply. The Fed, through open market operations, can receive money payments in return for selling treasuries, or it can pay money for treasuries it has purchased. Most of these sales and purchases are between the Fed and banks and investment fund managers. Okay, so here we've got a little storyline illustrating. So here's a guy named Mac who has a nice investment portfolio with $1 million worth of bonds, government bonds. Mac needs $1 million to build the house of his dreams on the beach in St. Augustine. He has the bonds, but not the money. So what to do? He sells his government bonds in the open bond market, and the Fed buys them. Mac's bank account balance now, and the money supply in general, has just increased by $1 million. Money just flowed from the bank where it wasn't part of the money supply to Mac's bank account where now it is part of the money supply after Mac sold his bond to the Fed. This is expansionary. So here's a sample test question. When the Fed buys bonds in the open market, what happens to the money supply and interest rates? Okay, so think about where the money flows when the Fed either buys government securities or sells government securities. So money can flow in one direction from an investor to the Fed in the event that the Fed sells treasuries, or it can flow in the other direction from the Fed to investors in the event that the Fed buys treasuries. And here's the answer to your sample test question. The money supply increases and interest rates in general decrease. When money flows to the Fed and out of the money supply decreases. The supply curve is shifting in this direction, and so interest rates rise, and it's contractionary. On the other hand, when money flows from the Fed to investors, money supply increases, reducing interest rates, and that's expansionary. Take a look at the table at the end of this presentation, and this kind of sums it up. And that is my explanation of monetary policy in a nutshell for Survey of Economics.